everyone. Thanks for joining today. We'll get started in just 1 minute, but in the meantime, if you want to drop where you're coming from, that'd be great in the chat. Okay, so hi everybody. Thank you for joining. Today we are going to be hosting a webinar with our partners at Nuveen Green Capital, Michael Doty and Andy Elliot. Michael Doty will be presenting for them. And here at Leyton, we have our energy efficiency expert, Andrea Gracia. And today's webinar is going to be all about 179D and 45L energy efficient tax incentives and CPACE. And we will cover monetizing equity and capitalizing deals in today's capital constrained environment. And I'm going to hand it over to Andrea.
All right. Thank you, Megan. And thank you everyone for joining us today. As we go through, I wanted to set a little bit of an agenda of what we're going to be covering. So looking at 179D and 45L tax incentives and who and what can be utilized for those. Obviously introducing our partners, going through the history of 179D and 45L, and then I will let Michael go ahead and introduce Nuveen and what they do and what they're looking to achieve here. So a little bit about myself, as Megan was kind enough to mention, my name is Andrea Gracia. I've been working in energy incentives for a little under 4 years now, and I've had the opportunity to deliver millions of dollars in 179D, 45L, and cost segregation. So I'm excited to speak with everybody and have everyone learn what they can do to really take advantage of the energy incentives. All right. So what does 179D mean for us? So 45L is, Leyton is a little bit different in our 45L and 179D. So for simplicity's sake, we are one point of contact for all three tax incentives. So we offer cost segregation, 45L, and 179D opportunities in-house. So we have our full representatives who will go through the process, in-house professional engineers, energy modelers, all in-house to be able to not only converse as to what information we need, but to be able to maximize those credits and deductions that we are able to deliver. As I'd mentioned prior, we have had the opportunity to deliver over 10,000 studies in each one of those disciplines to make sure that those who can do take advantage of the credits and deductions. And we have on staff representatives who worked with the DOE to develop the Zero Energy Ready Home standards. We're very proud to have that, the personnel in-house. And additional representatives that we do have, we have a former IRS special agent. We have those professional engineers that are licensed in several different states. We have our in-house CPA experts and our in-house attorneys. So we are a full collective team of specialists and love what we do. I'll go ahead and hand it over to Michael to give a little bit of an introduction.
Turn my camera back on here. Yeah, Mike Doty. I'm the director for Originations from New York City North for Nuveen Green Capital, where our specialty lender focuses on lending through the CPACE mechanism that we'll dive into a little bit later. And to date, we've put out about $2 billion through this mechanism across the country. Across all types of commercial asset classes and every geography where PACE has been enabled.
All right. So which client type should pursue 179D? So commercial building owners. So in 2005, as enacted in part of the Energy Policy Act, commercial building owners were eligible for 179D deduction. Beginning in 2008, it was opened up for designers. So a person or people who are considered designers are those who create technical specifications for the installation of energy efficient commercial building property. So that is just a fancy way to say those are who are design liable. So we're looking for those architects, engineers, and contractors are specifically called out in the tax code for those that can utilize the deduction. The deduction itself works very differently, whereas commercial building owners utilize the deduction themselves. Designers are able to go through government entities, so that is 2023 and prior are able to utilize those government entities. 23 moving forward, nonprofit organizations as well as tribal government lands have also been added to that as well. So moving forward to eligible building types. So for commercial buildings, we're looking for warehouses, offices, schools, hotels, student housing, just normal what you would think of commercial facilities when thinking about it. A couple that do stand out that most don't look at pursuing, especially for designers, are military bases, airports, so on and so forth. But yes, all of these are eligible, and if you have these commercial building types, it is worth you looking into the deduction to see how you can utilize and if it's something that is best for you and your business strategy. So a summary table of, in essence, what 179D is or how you qualify or what the qualification looks like for the deduction value. So in 2022 and prior, you have around 60 cents to $1.80 that you are eligible for to pursue for the deduction value. So there are 3 systems that 179D operates on. It's going to be the interior lighting, HVAC and hot water, and building envelope. So between those 3 systems, we're able to compare to an ASHRAE standard to a building as it currently stands, obtain the energy cost savings, and that's how we're able to calculate on a per square footage basis based on what is amounting for that savings requirement. Beginning in 2023 and moving forward, as part of the Inflation Reduction Act that was enacted in 2023, the qualifying factors have changed a little bit. So for those 2023 and forward, prevailing wage and apprenticeship are required in order to be able to obtain that full $5 maximum value, so that the minimum value is going to be $2.50 up to that $5 maximum. If prevailing wage and apprenticeship are not met, it is going to be up to $1 maximum. And again, that is per square foot. So there is still value to be obtained. It's going to be the same requirements or same 3 systems. The only differentiating factor there is now in 2022 and prior, 50% energy cost savings was needed in order to be able to obtain the value, whereas in 23 and forward, 25% energy cost savings is what needed. So we are very excited in order to be able to get that moving. So moving to how to take the 179D deduction. So for commercial building owners, there's a form 7205 that brings that's for your current filing. So it'll be the year in which you are looking to file. And for those buildings that are being looked at that are prior to that current tax year, you're going to have a 3115 that is going to be implemented for the commercial building owner. So that's just going to be everything relevant. Now for designers, they work a little bit differently in the sense of commercial building owners can go back and look at several different periods for qualification, whereas designers have that 3-year look back period. So it is a use it or lose it. And it's going to be operating based on that statute of limitations. So if you are interested, you're looking to have, move forward as a designer or a qualified party on that end, really make sure that you're looking at which years are looking to go out of statute, because it is a use it or lose it. So, and then for 179D, you have an indefinite carry forward period. So for 179D is one of the only incentives in which that is possible. So even if you can't utilize it this year, you can go ahead and utilize it the next, and so on and so forth. So history of major changes. So for 179D specifically. So as mentioned before, in 2005, it was part commercial buildings. We now have the new 2008 for designers, building designers, nonprofit, as I had mentioned before. So that includes churches. We have those tribal nonprofit schools, Alaska Native corporations have all been added as part of that Energy Policy Act. And we have that real estate inventive trusts that have been added as well. So it increased that deduction construction value by that 5 times multiplier. So previously that $1.80, now up to $5 per square foot. And we have prevailing wage and apprenticeship requirements that were added in addition to those energy cost savings requirements. So for 45L, now moving into that territory. So whereas 179D is a deduction, 45L is a credit. So specifically for residential properties. So you have single family and multifamily homes, which are going to be the targets for this credit. That looks to apartments, townhomes, student housing, condos, assisted living facilities. So anywhere, any place in which residence occurs. So what clients specifically should we look at for 45L? So developers, contractors, investors, those are going to be any of those who have basis within the construction process is ultimately who can qualify for and who should look at obtaining the 45L credit. Moving on into a case law. So for building designers, 179D must be taken in the year that it was placed into service. So if you have a building that was put into service during the 2022 year, that needs to be taken in that current year. It will have to be taken into that year 2022 and have the ordinary business income in order to be able to offset. So when working with a team, make sure that you have professionals that are looking into that to make sure that it is the best for you and your business strategy for your taxable income as you can continue forward. And then additionally, you must have that design activity. So again, creation of technical specifications is crucial in order to be able to qualify. And that is going to be quantified on the back end through that energy cost savings analysis. So summary table for 45L. So when looking at the multifamily, it's going to be also fractured in that 2023. So pre-2023, post-2023. So just looking at the multifamily prior to that 2023 deadline. So if the International Energy Conservation Code, so IECC, is met with over that 30% savings, it's going to be $1,000 per unit, or we like to call it per door. And if that 50% savings threshold is met, then it's going to be that $2,000 per door. And again, that is for multifamily. Beginning in 2023, the Energy Star Zero Energy Ready Home qualification was implemented. So in order to be able to pursue 45L from 23 and forward, you have to meet at least one of those criteria. So for Energy Star, if you have Energy Star certification itself, it is $500 per door. Prevailing wage was also added as part of the Inflation Reduction Act to 45L. So if you have Energy Star as well as the prevailing wage requirements that are met, you have $250 or $2,500, added per door. And then same thing for that Zero Energy Ready Home. If you have just the Zero Energy Ready Home qualification, you have up $1,000 per door. And then for that prevailing wage requirement also met with the Zero Energy Ready Home certification, that's going to raise it up to that $5,000. So again, 45L is prevailing wage prevailing wage requirements are going to be that 5 times multiplier here as well. Single family operates a little bit differently. So again, prior to that 2023 year, for 30% savings, that was $1,000. For 50% savings, that was $2,000. Single family does not have the implementation of prevailing wage, the requirements as set forth for multifamily. So if you have the Energy Star certification that is necessary for single family, you can hit $2,500 with prevailing wage and without for that Energy Star certification. Similarly, Zero Energy Ready Home, if you have that certification, it's that $5,000, and the same thing with prevailing wage. So we really want to ensure that everyone understands that single family homes do not need to hit that prevailing wage requirement aside from that Zero Energy Ready Home or Energy Star certification in order to be able to maximize that full amount of credit that you're looking to pursue. So how to take 45L. So there's a form 8908, or if looking back in that prior 3-year period, it's going to be a 3800 that you're looking. And again, those forms, if working with the team, we're going to make sure that you are provided all of those as well as communication with your CPA. We identify whereas they file. So you have that 3-year look back period for 45L. And for 45L, you have a 20-year continuation forward for that credit to be able to be utilized, whereas 179D, you have that indefinite carry forward. So operates a little bit differently, but ultimately looking to go green and incentivize energy efficiencies. So a little bit of exciting news for Leyton. We are now officially Energy Star rating partners. We're very excited to announce that and have that partnership working. Obviously, with that post-IRA 45L studies need to be Energy Star rated. We are excited to have those personnel in-house that assist with that and to be partnered with Energy Star. So with the Inflation Reduction Act that took place in 2023, a couple of changes that are necessary to note. So obviously that energy or that credit amount increased. So we now change from resident to Energy Star or Zero Energy Ready Home. It removed the 3-story height restriction. So prior to 2023, anything looking for 45L residences needed to be below that 3-story mark. We now have opened up to any stories that we are looking to qualify within however many units that are looking to be obtained. So we now have removed the reduction in basis for low income housing tax credit. So when looking at LIHTC, make sure you get in touch with one of our representatives to make sure that you're able to kind of talk through that in a way that you're kind of able to level set and see if that will qualify for the credit. And then it obviously added that local prevailing wage requirement. So common issues when considering a study. So particularly mentioning for designers, the allocation letter process is something that must be done, and you have a representative for whichever company you're looking to pursue. Will need to reach out to that government entity. They are essentially looking to issue a permission slip for the designer to be able to utilize the deduction. Again, wanting to make sure that you have that ordinary business income to offset, but you also need to be granted permission by that government entity. Now, that's where specialists such as myself and our team in-house are able to come in and have the conversations as to why you and your team deserve the qualification, or in which ways you qualify to obtain that deduction. Certification requirements. Now, professional engineer, as written in the tax code, is required to visually verify the work that was completed and sign off to ensure that the modeling is as close to possible, if not the same, as the building as it currently stands today, as well as the ASHRAE standard that was taken into place. So once the certified professional engineer heads out on site to visually verify, they will go ahead and stamp that certification, their professional engineering license on it, to ensure that everything, obviously, you're provided with that information upon delivery to make sure everything is within the letter of the law. Now, tax considerations. So for commercial building owners, particularly, you have that basis in the building. So 179D acts as an accelerated depreciation. So you are bringing all of that that depreciation up front. So it does create that liquid cash, but it is obviously it needs to be noted that there is depreciation in the in the building itself. So time owning properties, you want to make sure that you, in order to be able to maximize that amount of basis and just obviously able to utilize the deduction, you want to hold, it makes the most sense within 5 to 9 years to hold that asset to get kind of the best bang for your buck. So as we had mentioned, the basis reduction, what that looks like for 179D, 45L, and cost segregation. Those are accelerated depreciations. And then again, make sure you're holding the building. 45L, though, it is worth noting, is not subject to depreciation recapture. So again, when looking at those multifamily, single family homes, it is good to take a second look to see if any of these are in your best interest. But with that, thank you guys so much for listening to Leyton. I will go ahead and hand this over to Michael.
Hi, good to talk to everybody today. We can move to the next slide. Just by way of introduction on what we do. So we provide CPACE loans across the country. CPACE is an acronym that stands for Commercial Property Assessed Clean Energy. It's a public-private partnership that ultimately allows construction loans for the benefit of energy efficiency and renewable technology to be secured by a public betterment assessment, the same type of legal structure that's used for financing sewers or sidewalks or schools by municipal action. This is a voluntary structure where any private building owner can raise their hand and say, I'd like to be assessed X amount of dollars for the benefit of doing X, Y, Z, whether that be new construction, adaptive reuse, gut rehabilitation, or energy efficient renovation. We can move to the next slide. So what this ultimately creates is a structure that can be used in any of those 3 environments that I just mentioned, but also for funding the eligible measures within those projects. So typically speaking, we're funding boilers, chillers, windows, roofs, building automation systems. In some markets, we can fund resiliency measures, things like seismic hardening in California or flood and wind mitigation in Florida as two examples. And the use case is a little bit different depending on how we're financing the project. For new construction and gut rehabilitation, we're typically funding to increase leverage to some level and reduce the weighted cost of capital, depending on the other types of funds that we're lending alongside. Same can be true for renovations or repositionings, but if it's a mid-cycle asset, there might be a reason to utilize CPACE to do a more limited scope to keep in place advantage financing that might already be there. And then on the bridge and recapitalization front, in most markets, we're able to retroactively fund eligible projects. So if you just built a building that needs a little bit more time to stabilize, then CPACE can come in and help replenish interest reserves, replenish operating reserves, pay down an existing lender, and buy the property some more time to get through lease up, get through stabilization, or deal with an overrunning construction costs. Move to the next slide. What the structure ultimately creates is something that can be used for any commercial asset class. So it's easier to talk about what we can't fund than what we can. It's not a good fit for government buildings, municipal or federal or state-owned, or large universities, hospital systems, anything that basically falls into that mush market bucket. On the private institutional front, it's not that those entities aren't eligible to utilize CPACE. We can work with nonprofits and do in many cases, but we need to be able to get consent from anyone who has a secured mortgage interest on the property. And when we're talking about institutional counterparties, most often they will have complex bonding structures that make it difficult to garner that consent. So it's not the best fit for CPACE. It also often happens that organizations like that have access to lower costs of capital than CPACE can provide. So it's not as good of a market fit. We can move on to the next slide. This map is super exciting for someone who's been in the industry now for 5 years. It was not this green even a couple years ago, but we're able to lend in most states across the country. The most prominent commercial real estate markets where we're not able to lend are the Carolinas at this point, and we're working hard to fill that in. And Arizona is probably next up on that list as well. You can move to the next slide. So some examples of how CPACE gets used in practice. This is an example of a multifamily construction project in Philadelphia. We lent alongside a national bank on this deal, and CPACE really provided two benefits. One, it helps size down the investment that the senior lender needed to make to a level that was more comfortable for their balance sheet, but also this particular banking institution chose to underwrite CPACE as an expense. And what that did is, at the same level, last dollar leverage, increased the pro forma debt service. So what that opened up the possibility for was a couple extra points of leverage for the sponsor and a more cost-effective capital stack. The investments that were made that we were able to fund included the building envelope, lighting, HVAC, and some water efficiency measures that were included in it as well. You can pop on to the next slide. Another example, this one, similar suite of measures that we're able to fund, but slightly different use case. This hotel was mostly complete when we were able to fund it, and we funded the majority of the capital stack. In hospitality in particular, the debt markets have really started to pull back on that type of development while the market is still relatively strong. So CPACE can provide a significant amount of funding at rates that are significantly below market for hospitality in particular. It's probably our largest asset class, maybe second largest, depending on where multifamily ranks in any given moment. And Florida is a good example of a market where we really can scale up the size of our loan. If you look at the sort of ratio here, 30 million on an $83 million total project cost, we were the lion's share of the debt, with only some subordinate financing coming in behind CPACE to complete the project. And move to the next slide. This is an example of an adaptive reuse we did in Delaware. There was an existing motel property that was in bad need of improvements, both base building systems as well as aesthetic. And CPACE was able to come in and finance the majority of the value add work that was going on to the site, alongside an acquisition loan from a separate lender, and provide both an attractive capital stack to the sponsor, but also the long-term nature of CPACE was valuable here. This is a couple years old, so this building has changed hands since we've closed on it, and the new owner has actually assumed the CPACE financing. At the point of sale, it was significantly below market, so it served as an adder to the available value for CPACE. And last slide. So just to recap, sort of what this mechanism unlocks. It's low cost, long-term fixed rate financing that in existing buildings can finance 100% of the eligible measures, but more typically is funding 25 to 35% of the development cost. It provides a flexible structure. We can be flexible in amortization. We can be flexible in IO periods, capitalizing in interest, really tailoring a deal to make the development work and improve the pro forma. It's non-accelerable, even in the event of default. All that we can collect at any given point in time is what's currently due or past due. It's non-recourse other than a completion guarantee, which is beneficial for its cost of capital. You very rarely see non-recourse executions priced over the 10-year treasury in the 7 to 8% range. That's what makes it most attractive. And the transferability upon sale, I think, is one of the areas where we undersell the value of CPACE. Certainly prevailing market opinion today is that if we lend money at 7.5% or 8%, that 3, 4, 5 years down the road, building owners will have a lower cost of capital available to them, and we are prepayable at any point. So if that's the case, great. You're not locked into CPACE for the full term. But if markets move against the prevailing opinion, you've functionally hedged a portion of your capital stack with good fixed rate money. I would tell you that I was hearing the same things 3 years ago about how soon we were going to get repaid on loans that we were writing at 5.25% fixed for 25 years, as I'm hearing today. And I'm getting very few phone calls to repay our 5.25% rate. So that hedge can be very valuable if the market moves against you.
I think that we are all set. Thank you all for joining us today, and we look forward to potentially speaking with you all soon. Have a good one, everyone.
Thanks, everybody.
Thank you, everyone.